Hey, what's up everyone? Hope you're all doing good. So, I'm trading coach this side, and in today's video we are going to talk about day trading. The title of this video is not to do day trading without knowing these factors. So, one of the most important thing is most of the people who do day trading, they need to understand day trading is not as simple as many people think. All right. So there are three major factors you need to consider before you do day trading, and if you trade without knowing these factors, this can simply lead to unnecessary mistakes and losses. All right. So we will talk about all these three major factors in depth on this particular video. So make sure to watch the video till the end. And in case if you are new to my channel, I recommend you to hit on the subscribe button and tap on the notification icon, so that you can receive more insightful trading lessons and contents just like these. In case if you like to know more about me, more about my trading style, visit my website, that is www.tradingcoach.co.in, and let us get started. And here is the number one important factor: unwanted price gaps, right? So if you're an experienced day trader, I think you already know what I'm actually trying to say here. So unwanted price gaps can be a very big problem, right? So for example, if you look at this particular chart over here, I'm looking at Nifty 50 5 minutes time frame, and if you look at this the circles which I have drawn here, you can see that all these are unnecessary price gaps which happen between the price action, right? They break the price action in the middle. So these price gaps, they often take place in the middle, and they break the price action. They break the sequence of the price action, right? So what happens is you will not get a clarity when you're trading the markets when you see a lot of unwanted price gaps. And often what happens is, there are chances your stop loss might get triggered or your orders might get triggered. You will also face some unwanted slippage when there is a price gap just like these. So before taking any trades or before exiting from any specific trades, make sure you are doing that before the price gaps, all right, before or after the price gap. So don't try to enter within the price gap, or don't try to exit within the price gap. So try to take your positions before or after them. And the best way to overcome this particular problem is you can try avoiding any trades before any major news or events. All right. So before there is any major market news, before there is any major market events, don't take any positions, because what happens is right after major news and events, you will see some larger price gaps on the market. And also what I recommend is you can avoid taking any trades exactly at the market open or at the market close. All right. So don't take any positions around the market open, because during the market open, the market can really gap up or gap down very badly. And also don't take any positions exactly around the market close, because even there during the market close, we will have some bad tendencies of unwanted price gaps. So if you're a day trader, you need to pay attention to this particular problem, and this is one of the most important problems you need to avoid. All right, so the second big problem for day traders is you need to be aware of sharp rallies and sharp sell-offs, right? So this is something most of the traders don't really pay attention to, but this is super important, because what happens is when you see these sharp movements, right, prices can quickly reverse after these sharp movements. Okay. For example, if you look at this particular price chart over here, so I'm looking at Hindustan Unilever Limited 5 minutes time frame, and if you look at the price action over here, you can see I have highlighted these sharp knee-jerk movements. I usually call them as knee-jerk movements. So I have highlighted these knee-jerk movements with some flags. And you can notice here these sharp movements often lead to a kind of a reversal, right? So right after these sharp movements, usually what happens is prices can quickly go into a range or they can reverse the entire market direction. For example, if you look at the price action over here, exactly at this point, the first flag, there is a sharp sell-off, but right after the sell-off, you can see quickly the market changed the direction, right? And right after this particular moment, again the market changed the entire structure. It went from a rising rally market towards a sideways market, right? And again, right after the sideways market, quickly we had another knee-jerk shoot up in the stock prices. So these type of sharp rallies and sharp sell-offs are something you need to consider, and you have to be very much beware of. So my suggestions, or a simple advice is, you can try to fade these sharp movements in day trading time frames. So don't trade these sharp movements. All right, I know it can be a little unconvincing for some of the traders, and they think they can make a lot of profits by jumping into these large movements. But if you're a day trader, what happens is these large movements can often lead to reversal, and they can create unwanted traps in the market. Okay, so fade these sharp movements and avoid taking any trades because of FOMO. And I'm pretty sure you're already aware of what is FOMO, right? So FOMO in the sense, the fear of missing out. So don't take trades just because you have a fear of missing out the positions. All right. Okay, cool. So that's the advice. If you're a day trader, you need to keep in mind that traps and hunts are very common. All right. So when you're day trading the markets, you can see most of the time the markets are actually dominated by algorithms and machine trading. All right. So usually what happens is the stop loss orders and your limit orders, they are often hunted by these algorithms. Okay. So most of the time what happens is all these algorithms and these automated trading machines, they are very dominant in lower time frame, especially the time frame from 5 minutes to 1 hour. Okay. So right now I'm looking at Bank Nifty 1 hour chart. So some of the day traders often use 1 hour time frame, and some of them even use something like 5 minutes, 15 minutes, or even 30 minutes, etc. So whenever I am day trading, I usually look at 30 minutes and 15 minutes, but I'm not a big day trader. Most of the time I'm a swing trader. Only in some circumstances I do day trading, only if there is a right opportunity. But being said that, most of the traders look at 1 hour, 15 minute, 30 minute time frame to do day trading. And what happens is algorithms and machines are very fertile on these time frames. Okay. So most of the time these algorithms often hunt for stop losses. They often hunt the limit orders, and that's the reason why whenever you place any stop losses or whenever you place any limit orders at important levels, they often get triggered, and you often end up losing unnecessary. You'll end up making unnecessary losses. Okay. So yes, that's a big problem. So traps and hunts are very common on lower time frame. So my suggestion or my advice on this is, you have to trade only when there is clarity in the market. All right. So only if you see a proper clarity in the price action, you can take positions. In case if the price action is very confusing enough, don't take any trade. So avoid confusing price action. All right. And this is the most important step you have to take. So if there is no clarity in the market, don't try to take any positions. All right. And that's the third important factor. All right, let us do a quick summary of what we have learned in this particular video, and I hope all of you are following along with my lessons here. So just to do a quick summary, trading without knowing these factors can lead to unnecessary mistakes and losses. All right. So just to summarize, whenever you see unwanted price gaps, consider them, because they can be a big problem. And also beware of sharp rallies and sell-offs. Don't try to jump into them because of FOMO. And point number 3, the last but not least, traps and hunts are very common because of algorithms and machine trading. So be careful when you're day trading the lower time frames. So that's the lesson on this particular video. So If you like this video, kindly click on the like button, and if you have any doubts or any questions on what we have gone through so far, leave your questions on the comment section below. I will try to answer them. And last but not least, thanks a lot for watching. Happy trading.